Ladies and gentlemen, welcome to today's SOFTRAX Executive Webcast Conference. This call is being recorded. I would like to turn the call over to your host, Mr. Bob O'Connor, President and CEO of SOFTRAX, for opening remarks and introductions. Please go ahead, sir.
Thank you very much, and welcome, everybody. SOFTRAX is the leading provider of revenue management solutions to hundreds of companies, and many of whom join us on the call today. So welcome to our customers. We have several hundred registrants for this webcast, which indicates how much executives want to hear about today's topic, even in late August, from our distinguished speaker, Dr. Tony Sondhi, who is back by popular demand to make his follow-on presentation entitled Update on Current Revenue Recognition Issues, Post-Contract Support, Part 2. Tony delivered Part 1 on July 19th, and we are here today for Part 2. And Tony will be available for questions at the conclusions of his remarks. Let me take you quickly through our agenda. I'm just going to spend a few minutes talking about SOFTRAX and revenue management, and then we'll turn it over to Tony. Tony will dial it back a little bit and to go back to July 19th quickly for a quick recap, and then move forward, as I said, on Part 2 of his post-contract support discussion. For those of you who are unfamiliar with our webcast format, we leave about 10 minutes or so at the end of the webcast for you to ask questions, and we will conclude the entire webcast within an hour. To ask questions, you'll see now that there's an Ask a Question feature located in the lower left-hand corner of your console. Please, at any time during the webcast, please feel free to click on that, ask a question. I'll be reading the questions throughout Tony's presentation, and ask those, as I said, about 10 to the hour. The most commonly asked question is, can I get a copy of the slides? And the answer is yes, but we do make you work a little for that. You'll see at the conclusion of the webcast, your browser will automatically be directed to a very short online survey, and what we want you to do there is to give us your feedback. And we listen to those, and that's one of the reasons Tony is doing a deep dive on PCS, actually twice now, because that was requested that Tony and others do more of a deeper dive in our webcast. So you'll get the questions, you'll get the slides by answering that feedback. And then also, if you are also interested in CPE credits, CPE credit, all attendees are eligible for one CPE credit, but in order to do that, we need your feedback from the questionnaire, and you need to check off the CPE request. And lastly, if that wasn't enough, you get 10 lucky people will get a copy of the 2007 Revenue Recognition Guide, which Tony is an author. So that kind of concludes some of the housekeeping things. And let me just spend a few minutes on SOFTRAX and revenue management and how it relates to today's topic. So our company, SOFTRAX, delivers enterprise software that manages really all aspects of a company's revenue lifecycle. Throughout the U.S. and world, hundreds of companies from very different industries use our software products to manage their revenue, their billing, revenue recognition, reporting, and forecasting. And as you may know, SOFTRAX started by dealing with the complex revenue needs of software companies, and we are the clear leader in that market. And as you can see, we have grown to address the complex revenue needs of many other industries. In a recent survey by IDC and RevenueRecognition.com, it was found that most companies still use spreadsheets to manage critical revenue recognition activities, and this is a source of many material weaknesses for companies. And a result of regulatory pressure, and the pressure continues to rise as a result of Sarbanes-Oxley, you can see that more than half of the public companies and almost half of the private companies have changed their revenue recognition policies. And CFOs and other executives do not lack for challenges in today's environment. You see that they have operational challenges, mostly around their business models and the complexity of their business models, whether they have recurring transactions, on-demand transactions, managing subscriptions or maintenance or contract or billing. Certainly they have issues related to revenue recognition and compliance, and certainly many of the issues that Tony will talk about today with respect to post-contract support and other areas, certainly a key issue for revenue recognition issues. And lastly, they have issues with respect to visibility and performance regarding financial reporting and transparency and visibility. And our solutions are aligned closely with these challenges. Our billing and operational applications allow the improved efficiencies and to increase revenue. Our revenue recognition compliance applications focus on managing complex revenue and expense accounting to ensure compliance. And our visibility and performance applications provide solutions that really give a strategic benefit to people who really need to look at data in different ways and help make strategic decisions. At a more detailed level, our applications line up accordingly. Applications that help billing and operations, from contract management to contract renewals to complex billing and order processing. Deep and unparalleled revenue recognition capability, and many of these terms you'll hear Tony using quite frequently today, as you can see on the screen, and business intelligence applications, again, strategic application that provide management and executives the insight into better decision-making. And all of these applications can be licensed as a complete suite or individually, depending upon your infrastructure and your needs. And they are complemented by other applications, again, depending upon the breadth and depth of your needs with respect to revenue management solutions. So this unique functionality is really provided in two major offerings: a complete billing and revenue management solutions for several different industries listed here, whether software companies or software as a service, business process outsourcing, and so forth. These industries have specific needs that our applications directly address. Or other companies are a relatively new offering for us for larger enterprises that have already implemented or in the process of implementing an SAP, Oracle, or Microsoft environment. This allows for us to coexist nicely, providing revenue recognition, revenue allocation, revenue scheduling, and forecasting within an ERP environment. And important to note that this can be used for applications for what we call booked business, to manage the revenue for business that's already been booked. It can also be used for forecasted business if companies are looking to get insight into the revenue treatment before a contract has been finalized. And all of these are highly configurable for certain industries. So we are pleased that our customers report a great increase in compliance along the revenue recognition issues as well as Sarbanes-Oxley. Much higher efficiency ratings in terms of their entire revenue life cycle and all aspects of billing and revenue, and improved customer relationships as well. So our goal as a company is to help our customers increase their revenue, reduce their costs, all the while complying with ever-developing compliance issues and regulatory issues. So that concludes my remarks, and I'm happy to introduce Tony Sondhi, again backed by popular demand. Tony is currently a member of the Emerging Issues Task Force, EITF, of the Financial Accounting Standards Board, which we all know as FASB. He is the co-author of the Revenue Recognition Guide and a co-author of the Analysis and Use of Financial Statements, 3rd edition, and he's authored others as well. He's an advisor to many U.S. companies along the areas of consolidation policies, revenue recognition practices, revenue arrangements, financial reporting, and so forth. So I can't do you justice, Tony, with such a short period of time, but again, backed by popular demand, Tony Sondhi, welcome and thank you for coming.
Thank you, Bob. As Bob has just pointed out, we're going to take a look at post-contract support, and we began this exercise last month on the 19th of July, and we spent, I think, a fairly, sort of at least a packed 35 to 40 minutes discussing the basic issues in post-contract support. And it remains a rather difficult area for most of us. And certainly, when you're in software, and particularly these days, as there are several industries where the amount of software in their products and services keeps increasing, and as a result, more companies are falling into 97-2, 98-9, and therefore have to have the information necessary to apply these standards. Now, post-contract support in those cases certainly is a very difficult job, but it's always, as I said, complex. So let's take a look at the issues involved. As I said, we started this the last time. Keep in mind the fundamental and probably the biggest, most important reason why we need to be concerned about post-contract support is the fact that you actually have to separate it. In order to separate it, you need evidence of its fair value. And if you cannot separate it, it changes and therefore has an effect on both the amount and timing of revenue recognition. And those are probably, as you know, those are the pillars, in a sense, of our revenue recognition framework. When can you recognize revenue, the timing issue, and how much can you recognize? So let's take just a very brief look at what we talked about in July. Now, obviously, those of you who were not able to attend in July and are attending today, you ought to take a look at our slides, because this obviously isn't going to do justice. I'm just going to provide a fairly brief recap in a sense. Now, what I wanted to point out to begin with is please keep in mind what post-contract support includes. And in essence, there are two classes of service. That's the telephone support and then the bug fixes. Now, please be very careful with bug fixes. As I'm going to show you, under certain circumstances, companies only provide bug fixes, but that is being done or is normally done in order to ensure that the product meets the published specifications or the service meets the criteria that the seller has laid out. In which case, as I'll point out, bug fixes are essentially warranties, which are accounted for very differently than we do the normal post-contract support or what we normally think of as post-contract support. So the first thing is service. First component, services, telephone support, bug fixes. The second one is unspecified product upgrades and enhancements, which means you're thinking about there, we're talking about upgrades and enhancements that we don't have at the moment or at the time of the sale or delivery of the software license, but they are being effectively offered to the customer on a when and if available basis. You'll recall from the July webcast that I pointed out, not only is this component of PCS critical for companies that are selling software, but it also becomes a very, very big part of what you need to understand and account for properly when you buy another company that's engaged in a similar business. Now, please keep in mind also the second bullet point on this slide, which is very clear. The second point here is that you have to be able to account for it separately. If you can't account for it separately, as I said, you're going to bundle it up with a license and then affect both the amount and timing of revenue recognition. Now, the other point I wanted to make sure that you were very clear about is that upgrade rights that effectively entitle the customer to one or more upgrades and enhancements that are otherwise going to be sold separately. You see the distinction? The critical element here is that they are going to be sold, they will be sold separately. Rights to those types of upgrades and enhancements are not PCS. Rights to additional software products are not PCS. So what you have to do is be very careful about the distinction between the types of upgrade and enhancements that are part of PCS and those that are not. This is something that you should absolutely be sure about, not only in terms of accounting for it, but I recommend very, very strongly that you also be very careful about those in your contracts. Because your contracts have to be clear as to what is and what isn't PCS. To be, as much as you can make it clear, that would be critical. Now, generally speaking, we account, as I said, for bug fixes alone, apart and distinctly from the way we account for post-contract support. Now, just a quick final slide with a recap with respect to how we normally account for it. And fundamentally, it's ratable. But generally, the rationale for ratable is because it's not easy or sometimes even possible to show how those costs are going to be incurred so that you could effectively recognize the revenue that attaches to PCS on the same time schedule as such as you recognize, as you incur those costs. Of course, if you have evidence that shows you, then you can document that, demonstrate that costs with PCS are incurred on other than a straight line basis. In that case, you can recognize revenue commensurate with the way those costs are being incurred. But generally speaking, it's not going to happen. And finally, I want to remind you that it's only rare that you will be able to consider PCS as insignificant. And in that case, delivery is not assumed to be required in order to recognize the revenue. Now we're referring to, of course, one of the four basic criteria. That is persuasive evidence of an arrangement, delivery must have occurred, price has to be fixed and determinable, and collectibility is reasonably assured. Always keeping in mind that software transactions require a fifth condition, and that is you must have VSOE of the fair value of at least all of the undelivered elements. Now, let me point out before I get into at least two or three new technical practice aids, which is the implementation guidance that the ACSEC, the Accounting Standards Executive Committee of the AICPA, developed some time back. Now, the point I wanted to make was that I took a look and, in fact, have actually answered just about, I think, most of it. They're certainly not all, but most of the questions that you sent us after the July and during the July webcast. And what happened there is one of the questions that came up a few times dealt with this issue of bug fixes and how to distinguish those from post-contract support. And the fact that in certain cases, if they're truly only bug fixes, you get warranty treatment rather than PCS treatment. Another issue that was very put up periodically was the question of when can you consider PCS as insignificant? Now, please keep in mind that that SOP 97-2 gives you four different criteria to look at, and all of them have to be satisfied in order to consider that PCS is insignificant. And then there were certainly many questions that dealt with the technical practice aid, which I had spent probably more time than anything else in July. That's the one where you have one method of measuring or one model for PCS renewals for the first 3 years and a different one from years 4 and 5 onwards. And because you had two different models, you couldn't really say that you had VSOE. So that's the one I'd like you to be also very careful about. Go back and take another look. But if it is something that affects you, you have to be very clear on how difficult it is to recognize revenue there, which then also means that there's another indication that you've got to be careful with the contracts. Okay, now having said that, let's move on to at least three new topics. The first one, again, is Technical Practice Aid number 44, or 5144 if you like, and that deals with post-contract support during the deployment phase. Now here, the scenario that the ACSEC dealt with was the following. It said that you're selling software which is going to be deployed in stages, and the contract stipulates that post-contract support will begin 6 months after delivery of the product. Now, we add here an assumption. That is, this particular software vendor normally provides post-contract support to all customers during the first 6-month period after delivery. So notice that, PCS begins 6 months later according to the contract, but in that 6-month intervening term, everybody's still getting post-contract support. Now, one other point, an assumption that you have to keep in mind is that the amount charged for PCS will increase over time And that increase is tied into the customer's use of that product. So as the customer uses more seats or licenses, the amount charged for PCS goes up. Now, there's one last piece, and that is after 3 years, the renewal rate is set, and that's a specified percentage off the aggregate list price. In other words, keeping in mind the amount and the number of seats, for example, that are used by the customer. Now, what's interesting is that there is no VSOE, of course, in this case for PCS when the product is less than fully deployed, because the only thing we really have, the only time this vendor separately sells PCS is at the time of the renewal, so at that predetermined renewal rate. Now, keeping those different assumptions in mind, let's look at the two questions that the ACSEC answers in this particular technical practice aid. First, what's the inception date for PCS? In other words, at what point in time do you start recognizing revenue for PCS? And of course, implicit in this also is the question of over what period of time do we have to recognize the amount of the PCS that's implicit in the initial contract. And then the second question, of course, which you need to answer before you can actually allocate revenue, is whether you have VSOE of post-contract support under these assumptions. And the response that the ACSEC comes up with, which I certainly agree with, is that it has to. Post-contract support in this arrangement begins at the time the product is delivered. And the reason is very simple. All customers receive upgrades and enhancements during the 6-month period, which supposedly precedes the stipulated start of the PCS term. Now, the second question was, do we have VSOE? The thing is, the only time PCS is sold separately is after full deployment. And at that point, it is sold at a stipulated rate of the aggregate amount of licenses used, which means that that is your VSOE, or at least that's what you need to use to first determine whether you have VSOE. And if you decide that you do, in that case, what's going to happen is that you're going to take the portion that you normally charge for PCS, defer that because you're effectively providing in the initial contract 3 years of post-contract support. Okay? So keep in mind that the 3 years begins with product delivery, not on the stipulated date. Now, there's another post-contract support technical practice aid which has to do with the multi-year time-based license. Now, in this example, what we're looking at is the case where the contract or the transactions normally involve multi-year time-based licenses for software. And in addition, in other words, they include post-contract support for a portion of the licenses term. Okay? Now, what happens, in other words, is that if you're selling, in other words, say, the license for a 5-year period, it includes initial or bundled post-contract support only for the first year of those 5 years. And second, there's a renewal rate for PCS for additional years within that time-based license. So in my earlier example, effectively what that means is I'm selling 5-year licenses with the first year of PCS included, but I also tell you how much it's going to cost you for years 2 through 5, and so on. Now, the question, of course, that we're dealing with here is, does that renewal rate qualify as VSOE? In other words, can we separate it, or are we going to have a problem with the amount and the timing of revenue recognition? The answer here actually is one, it's a variant of what I'm sure you've heard before, which is it depends. And what does it depend on? There are two things. First, the actual renewal rate that's offered in the contract and the term of that renewal both have to be substantive. Now, let's see what that effectively means. The ACSEC identified 3 criteria that you can look at, or 3 indicators if you wish, and the existence of any one of these will imply that they're actually not substantive, and therefore you don't have VSOE. So please apply these carefully. The first one says that it compares the initial bundled post-contract term. Remember in the example I used from the previous slide, I said that the initial bundled term was just 1 year. And what happens effectively is what you have to do is compare that to the license term. So if the initial bundled term is very long relative to the license term, what you're saying, really implicit in that particular type of an arrangement, is the fact that the software product is actually going to be supported for a fairly substantial portion of its economic life, which means that post-contract support term then is too long. So one example that we've provided over here that the ACSEC provides us is that if you provide 4 years, that is, you bundle 4 years of PCS in a 5-year license, and then you have a renewal for the last year. So there, because of the overweight, in a sense, term, effectively the 5th year's renewal rate cannot or will not provide VSOE for the first 4 years that are bundled in there. The second indicator the ACSEC points out is where it compares the aggregate or the sum of the renewal terms that are offered relative to the initial term. Now here the point is, again, if the renewal term is very short compared to the initial bundled term, then you don't have VSOE. This you might want to think of this as sort of a slight variation of the first one, because after all, we're still comparing. Remember, in the previous example case, bullet point, I said, think about the 4-year initial bundled term, compare that to the 1-year renewal. So here we're talking about the aggregate renewal term being short compared to the initial term, which the 1 and 4 would work out the same way. But just keep in mind, in the first bullet point, we're talking about comparing it to the license term. In other words, the life of that software, the term-based license. Now let's look at the last indicator that the ACSEC pointed out, and here the ACSEC asks you to compare the renewal rate to the normal pricing practices. Okay? So the idea is, for example, if you have a 2-year term time-based license, including a 1-year bundled post-contract support, and the total fee for that is $1 million, and a renewal rate for the second year is $25,000. Right? So then what you're saying is, what you find here is the renewal seems very, very low compared to that. They think about what one normally finds for post-contract support, the amount charged for post-contract support relative to the license. It seems fairly clear here that $25,000 renewal rate would be hard to argue that it's substantive. Okay. Now, let's move to the next one where we have a slight difference, or sort of a slightly different scenario. What we're doing is, at times we sell software license for $100,000. At other times it's sold for $150,000. Now, most of us, I know, are aware of this. This happens quite a bit. So what's the issue here? What if we charge different amounts for the same product, charging different amounts to different customers, and yet we're charging 15% as the post-contract support? It's 15% of the actual license fee that the customer pays. Notice that it's not 15% of a stated amount, it's 15% of the amount charged. So the question here is, although the percentage is consistent, the dollar amounts are not. Because see, in the first case, where you sold it for $100,000, the customer's going to pay you $15,000 for post-contract support. But in the second case, where you sell it for $150,000, the customer's going to pay you $22,500, which is 15% of $150,000. So in that sense, the question is, do we have VSOE? Because in one case we're charging 15, the other we're charging 22.5. And here the answer was that you can it is possible to have VSOE in this case. Excuse me. The reason is that you're applying a consistent percentage. So long as it's a consistent percentage, you have VSOE. Now, the next one is a rather interesting technical practice aid, because here we're talking about fair value of post-contract support in a perpetual multi-year or a multi-year time-based license. So we've got one software product that can be purchased under a perpetual license, or it can be purchased under a multi-year time-based license. In other words, 2 or more years as compared to perpetual. Now, what happens is that the amount that this particular vendor charges depends on the term for which the customer purchases that license. Perpetuals, in other words, get charged a different amount than all the time-based licenses. Now, we do have, the additional assumption here is that we do have VSOE for post-contract support in the perpetual licenses. But for the multi-year time-based licenses, effectively post-contract support is bundled in. But what's interesting is that it's bundled in with the same term. So if you buy it for 3 years, you're buying post-contract support for 3 years. You buy it for 5, you get post-contract support for 5. Now, no renewal rate is provided because your license term ends, right? The license and the post-contract support terms end at the same time. Now, in that case, the question is, do the PCS renewal rates that we have for the perpetual license type of sale, can we use that as VSOE for the time-based licenses? Now, this is a very important technical practice aid, I think, because it's showing us how to distinguish between products. You see, we know, I did say, and of course the technical practice aid says it's the same product, but because it's sold in 2 different ways, there's a substantive difference between the 2. And therefore, you can't use the VSOE that you have on one as an indicator of VSOE for a different product. Generally speaking, if you had the same product, you could. And there are other technical practice aids, you'll recall, that deal with that. You remember the one we talked about in July, you may recall that one, where we said that there are conditions under which if you have 2-year renewals and 1-year renewals, taking twice the 1-year renewal could be VSOE of the 2-year renewals. But there, other conditions were satisfied. Here, what happens is that we don't have that, and the point is that the answer reminds us that VSOE is, generally speaking, the amount at which you sell that particular item separately. Right? So the point is that you're not selling it separately in the case of the time-based license. Therefore, these are 2 different deliverables or 2 different elements. Okay. Now, let's go to the last post-contract support technical practice aid that I dealt with. Now, here what we've got is the issue of fair value post-contract support in a perpetual multi-year time-based licenses. Now here, we detail the conditions under which post-contract support for a perpetual license can actually serve as VSOE for the time-based license. The first condition is that the term of the time-based license is substantively the same as the economic life of the software, which, by the way, for some of those of you who attended my seminars or have seen the 2007 Revenue Recognition Guide, you may recall that a perpetual license still requires that you understand and document what its economic life is, really. So in this case, the point is that if the term of the time-based license is substantially the same as the economic life of the software and the related enhancements that occur during the term, that's one condition. The second one that you have to satisfy is that the fees charged for the perpetual licenses, right, and the time-based license are substantially the same. So in other words, you have to show both the amount and the content of the services provided under PCS are similar. Okay? So, for example, if the vendor also offered PCS on the time-based licenses for a portion of the license term, then you might have a case, you might be able to make the case that your renewal rates now give you VSOE for the entire license term. And I recommend that you take a look at this other TPA 5154 for additional guidance. Now that brings us to 5176, which is a slightly different, this is actually the last technical practice aid that the ACSEC provided. And this one, we're talking about contingent usage-based fees. Now, what's interesting in this one is that you have licensing rights, post-contract support, and in some cases an initial payment, in other cases no initial payment. But certainly in both cases, a significant portion of the payment comes from the amount of usage. Okay? So the example that the ACSEC used was one where software is employed in a call center, and a fee of 1 cent is charged for each call that is handled at that center. Now, let's look at the issues. There are 3 scenarios that are provided to us. The first one includes an initial fee for the license as well as contingent usage-based fees. Now, by the way, you'll notice that all 3 scenarios, there's usage-based fees. The other assumption with respect to post-contract support in the first scenario is that for the first year, you don't pay anything for post-contract support. There is a renewal rate for subsequent years' PCS. That renewal rate is deemed substantive to begin with, which basically really gives away the whole thing. Because once you have a substantive PCS renewal rate, that means you've got VSOE. You'll see how that works in this case. The second scenario also includes an initial fee, non-refundable. However, the post-contract support is free, or you can think of it as being part of the contingent usage-based fee, which is also included in here. And the final scenario that we looked at was where there is a perpetual license, but there's no initial payment. Not only that, there's no charge for PCS. In other words, it's a perpetual license, and so long as you pay the usage-based fees, you get post-contract support. Okay. Now the question, in these scenarios, how do we recognize revenue for the license and for post-contract support? And how do we recognize revenue for the usage-based fee? Which that last one is really straightforward. Now, the first thing I want you to keep in mind that 97-2 actually does not tell us what to do when we have this type of a contract. And I give you paragraph 10, which sort of is the basis for my saying that it doesn't help us there. But let's look at the first scenario. As I said earlier, the fact that the renewal rate is substantive resolves the whole thing. Because it's substantive, that means we can actually carve it out of the non-refundable initial fee, recognize the amount that we thereby allocate to PCS over the term of the PCS. Okay? Now, of course, by the way, I won't repeat this for all 3 scenarios, but the usage-based fee, of course, is only recognized when you can actually develop reasonable estimates of the actual usage. Now, just a quick aside, the estimates of actual usage should be considered reasonable, reliable, only when you have some experience with it. If you change the product, if it's a new product, a new type of service, or a new version of it, you may not have enough information to say that you can develop reasonable, reliable estimates. And there are a lot of examples out there recently, in the last year and a half, of disclosures by companies switching the way they've recognized revenue because of the inability to develop estimates for new versions of their products and services. Now, the second scenario, remember, we don't know, there's no renewal rate, and therefore you can't say it's substantive either, which means you don't have VSOE. So you can't use the residual method, and it's not clear how you would be able to establish what the fair value of PCS is And from that perspective, the only thing you can do is take the initial fee and recognize it over the period that PCS will be provided. Notice that it will be provided. And finally, of course, usage-based fees are recognized when you have estimates. The third scenario, finally, then talks about is the one where there's only usage-based fees. No initial payment, nothing for PCS. But remember, we don't have any VSOE either in this case because we're not charging anything. The only thing we're charging here is the 1 cent per call in that initial example. If that's the case, all you can do is recognize that amount, the perpetual license right in PCS as time goes on. Okay. Having said that, that's what I wanted to tell you about post-contract support. Now, a couple of quick comments before I leave this and hand it back to Bob. The first thing I want you to be very, very clear about is this discussion today and the one we had in July, those are some of the most basic issues that concern post-contract support. Clearly, your problems are going to be a function of the types of contracts you have. And therefore, you really have to know your contracts and be very clear on those because it's possible that these technical practices won't apply to your issues. Right? So you have to be very, very clear on that. The other point is be very careful of arguing or claiming that you don't have to separate post-contract support because it's not, it's inconsequential or perfunctory, things like that. Because at some point you may change your mind and want to start charging separately for post-contract support. So these are decisions that have to be made up front. The amount and timing of revenue recognition for software companies is very much a function of the correct assessment, an appropriate assessment, and then subsequent reassessment of the post-contract support and whether you can separate it, whether you can allocate because there are issues. Is the post-contract support sold separately? Do you have VSOE? If you don't have VSOE, my recommendation is go back, start building, documenting the transactions, and gather the evidence that you need to develop VSOE as soon as possible. Okay? And I give you a seminar schedule. If you have other questions more deep, if you want to get further into this and think a little bit more comprehensively about either generally revenue recognition or software revenue recognition, I have a few different seminars. You can see that on your screens at the moment. Bob?
I'm still here.
Okay.
Thank you very much, Tony. I just want to remind people that many people submitted questions, and I appreciate that, and I'll get to those in a minute. And again, for those people who missed the earlier kind of housekeeping issues that I talked about, to get copies of Tony's slides, we're going to ask you to complete a questionnaire at the end of this, so look for that. Other people had questions about how to get the recording and the slides for July 19th. So as we said at the beginning, this has been kind of a two-part webinar, and the first was on July 19th. So if you went to find your initial email that was sent for this webinar, the link for it is there. It's also at our website, SOFTRAX.com. Go to the events area, and you'll see and be able to hear and to be able to see the slides and be able to replay the 19th because, again, a two-part session, and this is the second part. So that'll get you copies of the slides for the 19th, and at the end of this webinar, you'll get the questionnaire that will get you these slides and recording if you wanted to replay later on. So hopefully that adds some more housekeeping, more clarity for those people who've asked those kind of questions. Tony, lots of questions. I've kind of grouped them into warranty issues, VSOE issues, and other. Okay, so just kind of, and I'm going to take them in that order if I can.
Okay.
So a lot of questions about warranty. I'm going to try to bring them all together here and munge them together for the interest of time. So is there a level of PCS that is considered part of product warranty? Is there a level of PCS that is considered part of the product's warranty?
Okay. The I think it comes down, really boils down to what's the nature of the bug fixes. It also is a function of over what period of time you're providing that. See, keep in mind that generally speaking, most customers are going to figure out fairly quickly whether the product works according to specifications. So in that sense, if you're providing a service of bug fixes over a very long period of time, it starts to argue against it only being a warranty. So the warranty is likely to be shorter in duration than post-contract support. But the substance of what you're doing also matters. So if you're making sure that it works according to specifications, you're closer to a warranty than if it's a service that sort of adds. So you have to look at the actual substance of the services, the bug fixes you provide. It's not an easy decision to make, but generally speaking, you also have to ask yourself, what do you charge for? There are certain things that you're not going to charge for. Those are closer to the warranty than to post-contract support.
And that leads to another question about, it says you referenced in TPA 43, states that bug fixes to correct defects that are provided free of charge are warranty. What about when you do charge for them? So what if you're charging for these bug fixes to correct the defects? And would that put it under PCS or warranty?
If you're charging, you're certainly closer. You're getting into the PCS. You see, because think of it this way. It's unlikely that you can charge for something that your product ought to do, or something that you said it would do. So the fact that you're charging and your customers are paying, it's an additional service. So once you start charging, you move closer to that. You'll see in 43 that, generally speaking, they make a comment about free of charge versus not, where something is being, where the customer pays for it.
Okay. And if a warranty includes phone support and that support includes a help desk, therefore not warranty and PCS, can you ever have VSOE for the product because it is never sold separately? Never sold separately from PCS, this help desk function.
So but it's possible for a help desk function to be part of PCS. So, and, you wouldn't sell any, generally speaking, the three components that we think about, the phone support with or without a help desk, the bug fixes, and the upgrades and enhancements, those are rarely sold separately. So that's why very often they're considered as part and parcel of post-contract support. Now, the one thing I should mention is it really starts to get tricky, and you have to be careful in terms of contract terms and so on. The problem where you're using a third-party software and you're providing phone support. But generally speaking, you should be able to determine whether that phone support is something where, because you put it into your software, they're going to call you first. Or there may be an issue of who the customer called as a function of who is considered the principal in the transaction. So there, not only do you have the problems of 97-2, 98-9, the problem of separating bug fixes in the warranty part from the post-contract support, but you also have gross versus net issues. And so you have to be very, very careful about those. There are many companies out there that call themselves solution providers. And these are not chemical companies. They're providing different kinds of solutions. So when they provide solutions, they're effectively very often bundling products and services from others as well, other providers. In which case, it's very critical that you, when you're figuring out how you should report it, have to know whether it should be gross or net. And there are three different EITFs there which will help you figure that out.
Okay. Let's spend some time on VSOE because we have many questions on that, Tony. A lot of the questions had to do with the fact that, let's say, a new product And can you use renewal rates before you have sold the renewals? So you have renewal rates that are predetermined, and it maybe explicitly has it in the contract that states can be renewed at a certain rate. Does that help at all? Is that enough, or do we actually have to have gone through the renewal cycles?
See, generally speaking, it's going to be very, very difficult to come up with VSOE until you've actually had separate transactions. Remember that, or keep in, just note that there is one exception that 97-2 provides, and that is where management, having sufficient authority, decides that that is the price at which they're going to sell. So that renewal rate, is the rate that they're going to charge in the future. Now, please make sure that when you do that, if you're going to use that particular exception that the SOP provides, and that is management fixes the price at a certain, the renewal rate at a certain amount, in addition to ensuring that you sell at that rate or fairly close to it so that you can at least meet that 85% of your transactions fall within plus or minus 15% of the median renewal rate. You want to make sure of that, but in addition, you want to make sure that the PCS renewal term is substantive and that the rate is substantive. That part doesn't go away. But it's going to be tricky. Not always going to be able to use that because remember, the biggest point is that the amount of time that you have between when you establish that rate and when you start selling is very, very short. You don't have a huge amount of time. You should be pretty close to launch at the point at which you set that. You must document that, and then you must stick to it. So it's possible to do it, but there are lots of things that can trip you up. I just mentioned two of them. That is the renewal term and the not substantive. So if either one of those happens, you have a problem.
And Tony, there's some questions that you use substantive many times during the presentation. We had some questions about, can you be a little bit clearer about what is substantive? Or any guidelines out there that percentage rates or things like that?
Well, the simple answer to that, which none of the people who asked that question are going to appreciate at all, is that there is no quantitative guideline. We're talking about materiality, folks.
Right.
And, the problem with materiality is that, there's just no quantitative answers. But, there's a glimmer of hope. The FASB decided not very long ago to drop an FASB staff position they were working on that related to Staff Accounting Bulletin 108 on taxes. And they dropped that staff position simply because they said, this really asks about materiality and we should undertake a project on materiality. Now, unfortunately, you have to keep in mind the fact that the FASB is going to undertake or has decided to undertake a project does not provide any information about how long it's going to take. So that's not what I'm telling you. So the point is substantive is both quantitative and qualitative. Is it going to make a difference to a rational person's decisions? If it is, it's substantive. That's the best I can offer.
Well, okay. That's not what they're looking for, though.
Oh, but
they were looking for a number.
So that's how the question phrased very clearly on what they were looking for.
All right. Let's, a lot of our customers offer hosting and subscription services and things like that, Tony. But so there's some question about, have you seen general guidelines for PCS, VSOE be used for other recurring charges, such as hosting services, for one?
Well, the first thing with hosting is that you've got to figure out whether it falls under 97-2. So remember, there is an EITF that tells you about that. Now, having said that, once you do that, if it falls under 97-2, then using 97-2's revenue recognition requirements is what you have to do. If it's not a software deliverable, then it gets harder to analogize. But if you can show that there's substantive, there I go again. If there's similar, it's hard to avoid that. But if there's similar activities, then I think, I agree. I would say that you could support using or analogizing to what you do with PCS. It's still not going to take away the fact that you need evidence of its fair value. The other point I would remind people of, which is an unfortunate thing because people trip up on that very often, if it's not a 97-2 element, if it's not in the scope of 97-2, then you're talking about a multiple element transaction that has some 97-2 deliverables and others that are non-97-2 deliverables, which means you're first going to have to use EITF 0021 to separate and allocate, and then once you've got all the 97-2 apart from the non-97-2, then you go ahead and apply 97-2 to those that are 97-2 deliverables. So you have to be very careful. You must begin by first identifying the different elements or deliverables, then determining whether they are 97-2 deliverables or not.
Tony, some of our customers, and certainly we've had to build a lot of this functionality into our software about deferring expense and costs that are related to revenue. So a question here is, if you're deferring revenue under 97.2 and recognizing it over the PCS period, how about, what are the general guidelines with respect to deferring those expenses that are affiliated or associated with that? Or should we just recognize the expenses at once or match it with the revenue ratably over the period?
And it's a very good question, which a lot of people are concerned about, for the very simple reason that there really just isn't that much guidance on the deferral of costs. I mean, there are places where GAAP is very, very clear on that you can't recognize this, or you have to defer revenues. The guidance that I will point you to first is the 2003 AICPA National Conference, where an SEC staff member gave a talk on that particular issue, on which costs can be deferred. Now, there he pointed to FAS 91 and Technical Bulletin 90-1. FAS 91 deals with loan commitments and so on. Technical Bulletin 90-1 deals with extended warranty contracts. These are the two places where the FASB has talked about the types of costs that can be deferred. The general principle is that you can only defer the incremental and direct costs. But 91 and 90-1 are two different models. You're going to have to be careful to make sure which one applies to your transactions. And then go back and make sure that you've looked at the 2003 speech that I mentioned. Make sure you apply that correctly. Then those three pieces of guidance together will tell you what you can defer and how you would recognize it.
Okay. And a tongue-in-cheek question says, Part 1 was on July 19th, Part 2 was today. When is Part 3 coming? We'll keep it coming. So I think the point there is there's certainly a thirst for more. Thank you very much, Tony, not only for this session, but the July session. I'll remind people that to get the July 19th recording and slides, that's on our website at SOFTRAX.com under events. Tony, I'm sure that people found this very worthwhile. Thank you to all our attendees for their participation and their questions. I think we got over 100 questions, so I'm sorry not to get to all of them. So please remember, first, you look at the slide, you can see Tony's seminars of the fall, and hopefully are convenient for you and offer a lot more detail. The slide is now changed to show the link to get to our questionnaire. That questionnaire gives us valuable feedback. It gives access to today's slides, access to a CPE credit, if you like, an opportunity to win the revenue recognition guidelines, the guidebook, we're giving 10 of those away. And please continue to look for our online and in-person events through our website, SOFTRAX.com or RevenueRecognition.com or Tony's site as well. Thank you again, Tony, and thank you, everyone. Goodbye.
Goodbye.